Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Shackleton. You ready? Let's dive in. Welcome to day 2, Lockwood Holmes, founder and managing partner of Vincimus Capital. Today we're going to speak about the differences between multifamily offices versus typical RIAs, how you might think about diversifying across assets and within venture, and where they're seeing liquidity opportunities today, whether that's continuation vehicles, secondary opportunities, etc. Thank you, Lockwood.
Well, it's great to be here. Excited to chat with you guys for a little while.
Absolutely. You have a very interesting career path. Would you sort of give us the quick intro on how you sort of got to the point of launching Vincimus?
Sure, no problem. And I was talking to my COO yesterday, and we were talking about this podcast, and he was like, so I was like, yeah, I'm going to be on this podcast called Swimming with Allocators. And he goes, well, you should be able to talk very intelligently about that, being from Florida. And no joke, when I was growing up, we used to catch gators, and we would put them in our pond put them in our swimming pool, and my mom would come out. We'd even put little babies in the bathtub. So if it was swimming with alligators, I could talk intelligently about swimming with alligators. But we'll talk about swimming with allocators today. So
that's hilarious.
Yeah.
I'm very impressed that you were catching baby alligators as a kid.
Well, if you put a light on them at nighttime, they freeze, and so you could just literally go pull up beside them in the boat and just put them on the boat, no problem. They wouldn't even move. As they get bigger, it gets a little more complicated, and you obviously got to be careful about mama sitting around. So yeah, it was a fun pastime when I was a child.
I'm trying to think of what's the analogy towards investing or dealing with fund managers, but I'll just let the audience figure that out.
Yeah, we'll get to that later. So I'll give you a little context into Vincimus Capital and how I got to where I am right now. But basically, born and raised Jacksonville, Florida, and I grew up in kind of a very entrepreneurial home with regards to my family had a family lumber company. I grew up sweeping the lumber yard, working in the construction real estate space. We had insulation companies. I would install an insulation in Florida in the summer. They sold that company towards the end of my high school career, and so as a family, we kind of had liquidity for the first time. And as I graduated, we were exploring different opportunities, and obviously you have every single person, when you have a liquidity event in a relatively small town, everybody wants to have the opportunity to manage your money. And so we puttered around to a handful of different RIAs, a couple different wirehouses, and ultimately landed at a multifamily office that was really aligned from a value standpoint and really was leveraging kind of the collective resources of their clientele to offer private market access. And so 25 years ago, when they were doing this, essentially single family offices historically were the only ones really kind of getting into the private, pensions, endowments, and large single family offices 25 years ago. Yeah. And then so you've seen like the democratization of the private marketplace really over the last 2 decades. Yeah. And nowadays, every single RIA or multifamily office has some sort of access or exposure, and we can discuss what that looks like, because I would argue that they don't have a diversified exposure still, but they're having more exposure to the private marketplace, which is really great because it creates a little bit more movement. You have lower middle market, you have middle market, you have larger funds now. I worked in the we had kind of blue-collar PE company where we bought and sold operating companies in Florida. And then when the downturn hit in 2007, 2008, I told the family I needed to learn some new vocabulary words. And my wife and I came out to graduate school at Pepperdine University in California. Okay. And so so I came out here 15, 16 years ago and haven't left. I fell in love with the ocean and the waves and the community, and it's been a really great thing. And honestly, access to kind of the venture world and access to the private marketplace. So many people are constantly coming through LA, and so it's really been great exposure for a lot of my clients that are kind of all over the place. And so I worked in private equity after grad school in the restaurant space, buying and selling restaurants all over the country. We would buy franchises. It was really fun. And then when I was kind of having my second child and traveling on the road every single week, I decided it was probably a good chance to diversify and to take a look elsewhere and see what we could do. And I met a guy that had started an RIA 5 or 6 years prior, and he asked me to kind of do some consulting work for him. And I'm like, listen, I don't really like financial advisors. I feel like you guys are really trying to sell something. I've had a bad experience with you earlier in my life. He's like, well, why don't you come do some consulting work for me for a couple months and just check it out. And I fell in love with the business, honestly. Like, I fell in love with the idea that you're actually walking alongside people, and every single situation is completely different. People ask me about performance all the time, and you're like, well, I can talk about performance, but the reality of it is every single investor or client is completely different with their liquidity needs, their risk tolerance, their timing. And a lot of my clients are entrepreneurs as well. So we have to make sure that we have capital available if they're going to make any new acquisitions or bolt-ons or anything like that. So every single situation is completely different. So it's kind of like I almost have to work up a customized portfolio and back test it to show you kind of from a performance standpoint what we would look at. And then fast forward or go back to about a couple years ago. So the person that I went and worked for, the RIA, was phenomenal. We were part of that democratization of the private marketplace. I remember 10 years ago, Partners Group, KKR, and all these major private equity funds were beginning to try to get into the RIA space. Mm-hmm. And they're like, hey, and so I was sitting down with them. I was, in a lot of ways, I was some of the first meetings they took. And now, fast forward to today, where a lot of RIAs and multifamily offices have exposure to the KKR fund of funds, and you're seeing iCapital, the birth of iCapital. I remember the first pitch I heard on iCapital 7 or 8 years ago, and now it's become somewhat of a marketplace. If not the marketplace, they continue to acquire and bolt on there, which is really interesting, and offering more diversified solutions to the everyday RIA or multifamily office. So we were part of that story. We had tremendous success at that RIA, and then a couple years ago, I decided, I really wanted to go back into. I was running a company. I was managing financial advisors. I was managing the operations a lot, and I had gotten away from what I love the most, and that's kind of investing in the private marketplace, and then honestly sitting down and doing customized portfolios for clients. And so, I went out on my own and was able to bring recruit a couple of really great people to be a part of the team. And that was kind of the birth of Vincimus Capital. And as we discussed a little earlier, but prior to the call, Vincimus, that the name was kind of derived or influenced by Ernest Shackleton's story of the endurance. And I really like that because to me, and I do a lot of long distance paddle racing and stuff like that. And you're talking 30 to 40 mile races sometimes, and it's consistent, methodical over a long period of time that allows you to do well. If you come out the gates too hard, you burn out, you bonk, your nutrition's not right. So it's like that consistent, methodical over a long period of time. And I think that's, to me, what investing is. It takes patience. It takes setting a really good pace. It takes discipline. Diversification across vintages is just as important as diversification across sectors or classes, as far as I'm concerned. So that's kind of been that, and we've had a really good last couple years, and I feel like the markets, though they haven't been hot from a liquidity standpoint, I feel like they've been more opportunistic, specifically in venture, really over the last 12 to 18 months. A lot of the valuations have come down, so the entry points are really good. So it's hard, though, in that sense, because you're competing with, the S&P 500 index. It's, being on fire, and you're trying to convince, your clients. You're like, yes, they're having a great run, and that's great overall for everybody. At the same time, we still got to be consistent and methodical, because I still believe, and my thesis is that, we can win, 300 to 500 basis points over the S&P 500 index in the long run by doing what a lot of these Ivy League endowments, the Yale endowment, the Harvard endowment, have done over a long period of time, and so being able to communicate that when you have the stock market through the roof sometimes is a little bit more challenging, but it's that consistency, and communication and education.
No, I love that, especially that reference to Ernest Shackelford, and it's not because he shares a name with me, but just that story of endurance. I think it applies to allocators, but it definitely applies on the other side to GPs as well. I think, Alexa and I came up in a generation. Luckily, we started our careers where we saw that immediately, the downside, right? Graduating in, I think both of us were 2007. So you can see the downside of the market, but understanding if you make decisions and get good every day, right, and be persistent, no matter where the market is going, you're going to be sustainable and actually, find alpha. So I love that. What was, from that, all that experience, where did you see the real opportunity to starting your differentiated firm? Like, what themes and trends were you really feeling like you could exploit?
Well, it's interesting, to kind of go back to the story of, we started getting some of the bigger players in the private equity space, looking to come to the average RIA, are looking to begin conversations. I continue to be intrigued by, hey, how can I continue to get upstream at these guys? Mm-hmm. How can we, if they're raising money and more money's going to come from kind of the average, RIA multifamily office, how can we sell to those guys? And so I kept exploring upstream, and obviously, to digress just for a second, I also believe that, when you're investing in, a lot of my clients want to have impact with what they're doing. They want to be in touch with the investments that they're having. They want to be able to hear the stories of founders. They want to be able to hear even the portfolio managers on the GP side. They want to have relationships with them. And I think for me, I just feel like there was just so much more of an opportunity to have impact, and from a stewardship standpoint with every dollar that I'm investing, if I'm getting closer to the source, of the creation of the product or service or whatever that looks like. And then also, I just find it very interesting to be able to invest in things that are changing the world. Whether it's the agricultural technology space, or whether it's blockchain, or whether it's AI, or, so to be able to, to be afforded the opportunity from an accredited or a qualified purchaser. I mean, that, obviously you have to be qualified there, but to be able to have that opportunity to do that, to me, has been just as significant as the opportunity from a performance standpoint. So I do feel very much that there is a calling there. And I think that also significantly influenced, to get back to your question, Ernest, my pathway in order to be like, okay, I want to have time and resources to be able to invest now in those portfolio managers. And then, potentially looking at, even on the direct or the co-investment or the follow-on, I need to have opportunity and time and bandwidth to be able to do the due diligence necessarily to be able to invest the time to make those investments. And so that kind of also is what birthed, Vincimus and the growth and the trajectory. And, and not every client is good for us, honestly. Like if they don't align with that thesis, from a kind of allocation standpoint on the endowment, they don't align with kind of the patient capital side, because it does require patience.
Yeah.
We've been able to kind of offset some of that patience with kind of the private credit space recently in the last, 18 to 24 months. I mean, that's been on a tear. So, although you're paying ordinary income tax on that, you're not getting those capital gains treatment, But, there has been different. And then, even recently, too, we've started allocating a little bit more to kind of cash on cash, lower middle market, just non-sexy, companies. And there's been some really great funds there. So to kind of augment the portfolio on the venture side, I feel like I get excited. I wake up in the morning and get the most excited about venture. At the same time, I have to make sure that I'm hitting the non-sexy as well. Exactly. To be able to, to augment those, or to when you're J-curving, you got to be able to create return elsewhere, So that's always the challenge.
Since you brought it up, Lockwood, who is a good fit? We have a number of aspiring allocators, and maybe they're new to the space as a family office, small family office, maybe not, or just high net worth individual. Could you give kind of the criteria that you think is a great fit for your firm?
Sure. I mean, I think maybe I'll start with kind of an AUM, just because I think as an entry point into true diversification within the private marketplace, majority of the time you're having to write, in order to get into a fund, a lot of times they're looking at minimum check size of $250,000. Now, at Vincimus, because a lot of times I'm putting 10 to 15 clients in per deal, they potentially allow flexibility there. But the reality of it is you don't want to be over concentrated. I say you don't want to be diversified or overly diversified, but you also don't want to be overly concentrated too. So I think, for me on the AUM side, being able to have at a minimum 2 or 3 million to get started, and to have a pathway to kind of 5 plus, I think that's where you really can, that's the honey hole to get started and really creating a diversified portfolio in the private marketplace. And really, it takes at least 2 to 4 years maybe to incubate a portfolio, to get it to where it's not full J curve. So, a lot of times we'll start off in the secondaries and some stuff that's even getting into the fund of funds, stuff. I'm not I don't wake up in the morning wanting to invest in fund of funds, but a lot of times it's a great way to get initial exposure right out the gates. And so you are still benefiting from private market returns. So a lot of times I'll start off in the fund of funds and then end up kind of creating my own fund of funds, essentially with the portfolio managers and stuff like that. But the reality of it is, at the end of the day, is the same strategy. It's just, maybe you add another zero, could go up to well north of a couple $100 million if a client wanted to invest that much.
Okay.
And I think once you get north of that $100 million or a couple $100 million as far as investable assets go, you also have the opportunity, a lot of times to potentially even be the anchor or lead. And I like investing in $500 million or smaller funds. If it's VC, I like 100 or 50 or less. If it's PE, you're looking at $500,000, sometimes it's or $500 million, or sometimes it's a little bit more than that. But that's a legitimate check size. And when you have, so my goal at Vincimus has been able to kind of leverage economies of scale to write larger check sizes, to then either take a seat on the advisory council, the limited partner advisory council, to walk alongside them, or to potentially negotiate on the economics or whatever. But to be a part of it, I don't want to just write a check and just be passive. Yeah. I want to add my strategic networks. I want to be able to introduce them to other investors that Vincimus might not be a client of Vincimus or not. I don't really care. I think one of the things I was talking, I'm going to digress again because I think this is a really important point. I was talking to one of our venture capital partners, 10 VC. They're in Silicon Valley. Really great group of guys, and they're kind of generalists, but they're seed stage. And I'm on the advisory council there. And one of the things I didn't realize until I was on the advisory council with them was how strategic. I mean, they're having 3,000 deals come through a funnel a year.
Yeah.
And a lot of times they go delete in the inbox. Yeah. But they're seeing a lot, and then it starts that due diligence funnel, and they might do 6 to 10 deals a year, right? But there's something outside of just a product and service that tremendously adds value to the probability of seeing success on the back end. And one of the things that they stressed that I felt that was really significant is who's alongside you on the cap table. Mm. Because if you have someone that is not aligned with kind of generally your thinking with regards to kind of the trajectory of alongside the founders, because they're very significant with the influence that they're having. And if you push too early, or you don't take advantage of the opportunity early on, you could miss, or you go out and raise too much money, or setting the valuations. I mean, all that is incredibly strategic. So what I've realized as kind of an allocator, at the end of the day, I'm an allocator. I'm not, a venture manager, portfolio manager, is realizing the significance of making sure they're really good at what they do as far as walking alongside founders and giving them advice, and making sure that if they're in the seed game, making sure we're writing large enough checks to be able to be on that board or whatever that looks like from an influence standpoint. So, that to me has been something that that's why you see a lot of times these new fund managers, and they don't have necessarily the experience and walk alongside founders. That's scary to me. That's really scary to me, because even though they might be able to network, identify really great deals, doesn't necessarily mean they're going to be able to hit that sweet spot when you start to look at exits, or be wise, or not be too greedy, because it's complex,
Yeah.
Yeah. You've talked about diversifying across venture and across vintages. Is there anything you're specifically looking for right now where you say, oh, I've got a gap and would love to meet teams that are focused on X, or I'm really excited about, selecting a manager who's focused on Y?
Yeah, I mean, I think I'm always open to taking meetings. At this point, over the last couple decades, I feel like I've built a really good Rolodex of managers. So I might take on 1 to 2 new managers a year. But
Okay.
I'm all about slow dating. Let's hold hands before we kiss. I really want to make sure I get to know them. And then for me, kind of my ethos at Vincimus is our core values are being steadfast, immovable. I don't ever want to push my clients from a timing standpoint to get into a deal. At the same time, I don't ever like to be pushed from a portfolio manager or, a fund manager or GP to get into a deal. Anytime I feel that stress or that anxiety, now certain times timing, you have to be opportunistic and timing lines up, but it's at the same time when there's that pressure, and even with my clients, the way that we do it is, I have a weekly investment committee where I'll have 10 or 15 different opportunities, green light, yellow light, red light, that are constantly coming through. And when we look at our client portfolios and see who's available from a diversification standpoint to participate, I will then actually say, hey, this is my recommendation. So there's maybe some different opportunities there. Because certain families have certain convictions about certain things. Defense tech sector. I mean, I love defense tech, but some people, so there's obviously an element of education there. But sometimes there's certain convictions that certain families have that they don't want to participate in certain deals. So, but I want to make sure that I'm augmenting that to make sure that we're still diversified. So yeah, slow dating is really important to me. And then, right now, like when I'm looking at venture, I was just pulling up before we jumped on this call, some of our fund managers. But, from a macroeconomic standpoint, we like to look at, where we believe to be a lot of the opportunities. I heard this from one of our fund managers, but he says, good deals don't have wings, So that's the question I ask. I tell my clients all the time, and I ask myself, it's why am I seeing this deal? I'm an allocator, so by the time it gets to me, it's B or C level at best.
Yeah.
That's why I pay my portfolio managers the 2 and 20 off the times.
That's true.
And then my clients, I'm like, guys, love you guys. You're very smart, and a lot of them are some of the best entrepreneurs that I've ever met. But at the same time, if they're getting a venture deal and they're and they own a bunch of car dealerships, I'm like, why the heck are you seeing this deal? I mean, that's like D or F level, maybe like Z, And it's like, man, how many times have they missed out on, that fund had to go around to the people that first invested in the seed. They didn't come back around on the series. So like understanding the story behind it. And it's not that you can't find a gem or a diamond in the rough sometimes, but the reality is from a probability statistical standpoint, you're just really not, especially if you're trying to get a rebound where they mismanaged cash flow or they went out the gates too high. Like it's really hard to get momentum start, back up when it's been lost. And so I really, really put a lot of weight on the general partners that we're investing with as an LP. Like it's very significant to me. Anytime I get a deal in relatively their realm, I kick it to them. And most of the time they're like, yeah, saw this passed, or okay, Lockwood, you're not going to be the one getting the first swing at that, even though you have good relationships, So anyway.
I respect the self-awareness. Not everybody has it.
Well, I've got my butt handed to me too many times to think that I'm that smart.
Self-awareness and humility has a cost. Now we're going to take a quick break to speak with our sponsor.
One thing I've always been impressed with SVB is no matter all the different groups, all the different functions, there is a seamlessness of like working together and utilizing different attributes. And so curious with your team being kind of on the front lines in financing, how best do you use those other things? Like one thing that comes to mind is the research that you all put out is phenomenal. And how do you leverage that and leverage other groups to then provide the best product to your customers?
I think the way I'll describe it is the following. So if you think about what faces a client or an acquisition, a potential acquiring of a client, we have our relationship managers who do a tremendous job of outreach. We have my organization where we're focused on ensuring with the relationship managers that they have a fulsome or a holistic relationship with all of the capabilities that it takes to actually transaction that. And we have relationship advisors who support primary relationship managers to ensure that it's a great client experience that's consistent across the relationship with SPC. That is at our core because we recognize that there is specialization in the way that you interact with client organization. From a fund perspective, like I said, we talked about FCD, there's a lot of treasury product transactions, especially when we get into things that happen in the FX space, as well as in trade and liquidity, where insured cash sweeps, lots of small, what I'd say, capabilities that most founders and more VCs don't have easy access to, or if they have that access to it, they would have to find their way through a commercial bank situation in order to find that, which is not that easy. And then I think most importantly, like rebuild this network over time. So I gave the interior platinum reference for there is an ecosystem of innovators who are multi-time founders. There are folks who've kind of grown up with us, being a founder, maybe they exited with a great company. A few of them, produce some unicorns along the way, and they are like almost like a referral model back to us. So when you want a bank to understand you and what you're about, SVB is the place to go because they have spent the time to understand your business and understand how they can help you. They don't just treat you as like the next number in market.
Absolutely. One thing I wanted to get your perspective on is it's been some time since the acquisition by First Citizens Bank. Curious, what adjustments or innovations has SVB made to maintain its relevancy and leadership in the venture ecosystem?
I think a couple of things. I think First Citizens Bank has been wonderful as kind of our parent company and allowing the culture of SVB to flourish. They have been all in on ensuring that we are connected with our clients, recognizing that our place in the innovation economy actually not only reads the ability to actually grow the macro economy, but also is a profitable specialized bank. They're not trying to turn us into a regional bank. They have that as a part of their portfolio. So they recognize the specialization that we have and are encouraging it. I'd say what we're doing and what you'll see from us in the next year or two is our ability to take our digital assets and put that on a larger, more complete platform with FCD's, support and help for us, such that we're able to actually roll out capabilities faster and be able to scale. Their ability in being around for over 125 years and knowing the banking business very well is going to be nothing but a boon to us. Our specialization in understanding what happens within the innovation economy allows them from an underwriting perspective to get really surgical around how to actually best help innovators, especially all the way up through VC firms. And look, I think there's a lot of dry powder that still exists, given all of what's happened post-COVID. And I think that we are going to be continually positioned to be very successful in the business that we've done.
Well, I can tell from this conversation, your leadership, intention, and thoughtfulness will definitely put you guys well positioned to do all of that.
And now back to our LP interview.
So Lockwood, is there? You've been looking at this space and kind of private asset classes for a while, specifically with venture. Is there a new approach you're taking with fund managers now? Because we've seen a couple different cycles since you've been in this space and around it.
Yeah, I mean, I think every situation and every person's different, and every thesis that they have. Personally, I like it when there's a specific thesis and niche and venture with what they're going after. If they're defense tech, I want them to be defense tech. I think where we've gotten hurt before is when there's scope creep and they're getting too broad. And like let's take AI for example, or even blockchain. There's actually a ton of application that like it's very broad, so like you could actually be really, really good at AI and be really diversified in your venture fund because you're seeking a lot of tactical application, which I think is where the opportunity is. Like if there's not application opportunity, and then you're seeing the big boys commoditize, AI. They want to make it free as much as possible so that they can really leverage. I mean, that's what Facebook's doing. That's what Microsoft's doing. So I think you got to be pretty strategic with what you're doing and tactical with regards to. So I like that, especially because I have pretty broad exposure to some really good venture managers. Whether it's biotech, blockchain, deep tech. We've even seen a lot of insure tech, defense tech. I think I've already said that some of those. Those are kind of. I'm just making sure. I don't like to be overly redundant. I like to find a manager that is, hey, this is kind of what they're doing, and then it allows me, to then kind of build out that diversification within the venture space. Ernest, I would say that we've seen some creativity with regards to how the typical, funds are being set up now with potential, because what we're seeing and is, a lot of these 10-year with 2 1-year option funds are now coming, like last year, for example, like what's really, I would say honestly, 'cause I want to come back to this point, but I want to provide a little bit more context into it because it's really challenging. So for me, as an allocator in the private marketplace where we're trying to push 50% to up to 75% of the portfolios into the private marketplace, we have to be very, very thoughtful and methodical with regards to cash flow planning. Because you have capital calls typically over a 3-year period, right?
Yeah.
And then, distributions are hopefully by year 6 you have your principal back. Hopefully in venture it actually is a longer tail.
Yep.
And so you can make all the assumptions that you want, but if the regulatory environment or the interest rates or like it's like last 18 to 24 months it's getting better obviously, but if it's locked up, if they're acting if a portfolio manager is acting as a fiduciary, which essentially they are with regards to they're acting in the best interest of their clients, they're going to push for a 1-year option or 2-year option or a continuation vehicle because it's not in the best interest to then sell. So at the same time, I have to make sure, I was taking, from a cash flow management standpoint, we have these massive spreadsheets on every client that are, 20 years out with regards to cash flow planning. I mean, that's why like when people push back a little bit on fees that I'm making, I'm like, you don't understand. This isn't just a, modern portfolio theory, algorithm that people are putting into the public equity markets. This is very sophisticated. And by the way, it changes every single call that I have with a portfolio manager. Fast forward to having 30 portfolio managers or 30 private market investments, and it changes every quarter on liquidity or capital calls or distributions. Like it's an ever evolving puzzle, which is what I love.
A 3D puzzle.
It's but I love that. Like it's fun because it's creative and it's changing. My ADD kicks in. It's like, okay, today is completely different than yesterday. So that's what gets really fun. And then communicating on the front end. So a lot of times I'll like to create 2 or 3 options for liquidity. So I've really been exploring different, whether it's quarterly or monthly liquid options that are in the private marketplace that give me a little bit of an on and off ramp if I need it from a cash flow standpoint. And then also like I said, a lot of, Ernest, getting back to your question on who my ideal client is, a lot of the people that we're working with are first and second gen, entrepreneurs. And so they understand and get the approach that we're taking to the private marketplace. A lot of traditional third, fourth plus generation, they're so far removed from kind of the entrepreneur. And I don't mean this in a critical way. I'm generally, this is not always the case. I'm just generally speaking here. They're so far removed from that. And a lot of times their wealth, if they're continuing to grow at a 6 to 10 or 5, like it's so substantial at that point. They already kind of have a lifestyle locked in. There's no, what's the terminology that they use? They, with regards to, they're not necessarily in the multiplication game. They're in the, I'll think of the
maintaining.
Concentrated. Yeah, they're
Yeah.
concentrated.
Yeah, so they don't necessarily a lot of times jump into this kind of entrepreneurial approach, and because I invite clients to be a part of the story,
Yeah.
and I also I would say with our clients we get a question, probably 3 to 4 questions a week with regards to their businesses. And hey, can you give me an update on kind of multiples on what you're seeing in the space? And I'll connect them with one of our fund managers to at least have a conversation on kind of what potential exits look like. And sometimes they'll even exit to some of our funds, which is amazing. So you have a built-in relationship there. I would say that's a tremendous value add to have a client that's an entrepreneur that has a company that's doing really well, that potentially has recapitalization opportunities within the family of clients right there. Or intel that's kind of insider intel and someone that's already done it that we can connect with. So I think that at the end of the day, I always put wealth into kind of 3 major buckets. And I would say four buckets if I include philanthropy, because I think to me, from a stewardship standpoint, philanthropy is a big part of it. But the first bucket is kind of institutional capital, like as far as we're managing it, institution, like the due diligence, the types of businesses we're investing in, and that's your traditional kind of multifamily office allocation that I'm doing. Then you kind of have your entrepreneurial bucket, where it's operating companies that clients are actively engaged in. Now they're going to always see the highest return on investment, and a lot of times they're like, well, what does that bar need to be for you? And I'm like, it needs to be at a minimum in the 30s. 30 plus, 40 plus IRRs. Otherwise, we can invest in 20 to 30 percent opportunities and be passive, and you can go sit on the beach and go
Totally.
fishing, in Cabo.
Get better at pickleball.
Get better at pickleball. So, but a lot of times that risk and that reward, and by the way, they get a lot out of that. I know some of my clients love going into the workplace every single day and never want to retire. So
Yeah.
being able to have some actively engaged, operating companies or whatever that potentially looks like. And then the third bucket I put real estate in, because it's kind of a hybrid. Sometimes it can be income producing, sometimes it can be more passive. But I like to see those buckets like a third, a third, a third. It's never going to be perfect, And then you have that philanthropic bucket too, that at the end of every year, we just got off, out of. December is always our busiest month because we're, tax loss harvesting. We're trying to do projections on potentially what cash flow looks like in the next year, and then we're doing a lot of the philanthropic giving because we'll engage into donor advised funds. And by the way, I don't know if you guys have explored much the evolution of the donor advised fund, but it's tremendous what you can do in donor advised funds. I can make the same investments in the private marketplace through different organizations like Impact Foundation, or there's a lot of really great donor advised funds out there that allow you to steward dollars actively. Whether you're investing in emerging markets like in Africa, or there's so many different entrepreneurial type things that you can do for profit and nonprofit, and you can just have them in different buckets. And people don't understand that. So if you wanted to have a DAF and create an endowment for your family and let that thing multiply and bake and then distribute off that a year, it's kind of like a poor man's foundation or a poor man's endowment. So there's a lot of creativity that goes in, and I get just as excited about that as I do, do on the for-profit side. Because to me, it's all blurred. Like to me, impact just doesn't mean philanthropic. Impact is everything.
No, especially if there are some funds you're interested in investing in that don't necessarily promise the same returns that you're looking for, it's a great solution. Your point on the concentration is hilarious. I was chatting with my dad the other day, who's a successful exited entrepreneur, and he was saying he wasn't stressed out at all about a concentration I've got of like 20% of my net worth in a single company.
Yeah.
And he was like, what? No, like 90 didn't even keep him up at night. You know, like when you're the one who built the business, you're like, you get used to that. I wanted to get back to your points on cash flow. In terms of some of these liquidity things you're getting pitched, are there any you've just like, I'd love to hear any you think are just total garbage, and what you are actually recommending to your clients? Like, what are some of these, whether it's secondary funds or that are intriguing to you, and why?
Yeah, I mean, I think you have to be really careful because, I mean, even in I was talking to a buddy the other day about the private credit space, and I feel like it's been a really good ride over the last 24 months. I mean, you're seeing these interval funds that are quarterly liquid, doing 12 to 14%. Now, that's ordinary income, so you have to cut it in half pretty much. But
unlike the endowment,
unlike the
that doesn't have to pay taxes on that.
Yeah, or it's in an IRA or something else. A lot of times we'll do our income producing stuff in tax advantageous vehicles. So we push those a lot of times to IRAs and stuff. That's a really good point that you made. Thank you for that. I didn't think about it. But we do that, and I think and even like a lot of times we'll have oversight into 401ks, and you can be creative with your 401ks. So a lot of times I'll get my public equity exposure in the 401ks, leverage the IRAs for the private credit, and then do long-term, private equity type investing in the non-qualified accounts, the non-tax advantageous accounts.
Now, I don't know if you provide any advice to your fund managers who are emerging managers on that, view, if they have certain positions within, whether it's the whole fund or, specific positions in companies. How do you feel about that on them, maybe maybe it's their golden goose, but they need it to show some DPI?
Yeah, I think, once again, the context is really, really important in understanding that story. I talked to a GP the other day, and we talked about, follow along investments. And, a lot of times what you're seeing in the space is a lot of times people write checks to participate in co-investment or follow on investment opportunities. And what they communicated to me, I found very interesting. They said that, hey, if I knew when I'm raising that fund that these clients were setting aside a particular amount to participate and follow on, then I could keep it cleaner than potentially having to do a fund two. Because to me, fund two with the same investments or a couple continuation vehicles in fund one doesn't really give me that diversification. I'm already exposed there, and that potentially means I'm coming in at a higher valuation on that same thing I've invested in. I don't know. I'm a little bit murky on that. That being said, a handful of our portfolio managers have done that, and they felt like there is significant. Like I had a friend approach me the other day that has been invested in the first 3 or 4 rounds, and he's like, "Man, this thing is an absolute winner. It's in the biotech space, and the valuation's significantly high." And so I'm like doing the math on what it would take to get a 5 or 10x, and it's just like so astronomical. I'm like, look, there's so much risk in biotech, like. And that's the thing, same thing in venture with valuations. Yes. Like if you're coming in at $20 million, which there's still a lot of people coming in at $20 million valuations, for that to get a 10x, you're looking at that's significant. If you're coming in at a $5 to $7 million valuation on a seed round or whatever, okay, if that hits 100 mil, I'm doing really well. Like I like that. It's easier for me to grasp. Now, sometimes that can be really me being short-sighted and not being as much of a visionary. And I mean, we have the NVIDIAs, we have these crazy things that, you're like, oh, I'm too late to the game. And then all of a sudden they double again. You're like, you gotta be kidding me, But, having a triple unicorn from a statistical probability standpoint is, very, very, very low. especially given the particular space that they're participating in. So I don't know. I think understanding the context, understanding the narrative behind it. I don't necessarily love it when a fund manager just rolls, into the next fund. At the same time, I get it. The other thing that I've been seeing recently too, which I find to be pretty creative, and I think it's going to be a lot of administrative work, but I also think it's a value add that GPs can add to LPs, is kind of I recently invested in a fund that has an annual liquidity opportunity after, let's just call it a 3-year lockup, where there's already a preset discount to any LP that wants to get out, and the first right of refusal goes to the GP and then to the LPs, or sometimes they'll say, look, whether they say people get preferential treatment, whether the LP or GP, like, people do, right? Like, that's just this. And a lot of times the GP will gobble it up because they believe in what they're selling the most, right? But I think that's unique. If you just said, hey, every year there's going to be a 10% discount on valuation, and you could have potential, like, that's attractive to me. I don't mind taking a 10% haircut to be able to potentially move capital. And, I have clients that all of a sudden, a big opportunity comes up that they want to make an acquisition, and they might want that capital. So for them to take a 10% discount, no problem, 100%, they get the capital they need. So, I don't know what question I was answering there. I know I probably went out on a tangent, but yeah, I think it's interesting to see the evolution of how these things are being structured.
It's a cool example of how the GPs themselves are solving the liquidity issue up front.
Yeah.
Fabulous. Well, we've covered every topic imaginable. Thank you, Lockwood. Any final thoughts for this audience?
Even if you're potentially looking to find a new financial advisor or a multifamily office, I tell clients all the time that are looking at me alongside the fact that the statistics speak for themselves with regards to having a financial advisor. If you're entrepreneurial and want to have more impact in your dollars, I fundamentally believe that the private marketplace is a great place. I think it's a phenomenal place. I think you have to have patient capital and realistic expectations. And I think at the end of the day, aligning with people that you can do life with, because just like when we make an investment with a portfolio manager that's in venture capital, private equity, that's a decade right there. If I don't like that person or we don't get along, like, why would we? Same thing with choosing a financial advisor. You got to have someone that you align with from a value standpoint, from a worldview standpoint, and someone that hey, you know what? My heart rate's not gonna go up if I get a phone call from these guys, And so I think that's just important. I'm fine with them slow dating me as much as possible in order to make sure that relationship is right, because that just means that there's more alignment in the long term. So I don't think, I think patience is really, really important. Narrative's important. Context is important.
Well, Lockwood, we really appreciate you joining us on the podcast. And if someone wants to find you, how do they find you in the Vincimus team?
Sure. You can go to our website at vincimus.com. Got that .com. When you go to a kind of a harder word like Vincimus, you got to go to Latin. You can still get the .com. So my email should be there, and you can send a quick email, and we'll follow up shortly.
Fabulous.
But yeah, thank you so much for having me. Really, it was great.
Thanks for being on.
Absolutely.
See you later, allocator.
After Portfolio Tile, investing with a smile.